For decades, investing felt like something locked behind a desk. You needed a bank advisor, a broker, paperwork, fees, meetings, and a level of confidence many young people simply did not have. Investing sounded serious, complicated, and expensive. Then apps changed the experience. Now a person can open their phone, deposit a small amount, buy a low-cost ETF, automate a monthly investment, and build a portfolio without walking into a bank branch. This is the ETF boom, and it is changing how a new generation thinks about money. An ETF, or exchange-traded fund, is basically a basket of investments that trades like a stock. One ETF can hold hundreds or even thousands of companies. Instead of trying to pick the perfect stock, an investor can buy broad exposure to a market. That simplicity is powerful. Young investors grew up watching financial crises, inflation, housing stress, and uncertainty about retirement. They do not always trust traditional institutions to protect their future, but they do understand apps. They understand automation. They understand low fees. They understand control. And that is why many are replacing old banking relationships with investing platforms. The first reason is access. In the past, investing often felt like you needed a large amount of money to begin. Today, many platforms allow small monthly contributions. Some allow fractional investing. Some make recurring purchases easy. This changes the psychology. Investing no longer feels like an event. It becomes a habit. A young person may not have $10,000, but they may have $50 a month. If the app makes that simple, they can start earlier. And starting earlier matters because time is the one advantage young investors have. The second reason is fees. Traditional financial products often came with layers of costs: account fees, advisory fees, fund fees, trading fees, and products that were not always easy to understand. ETFs made the fee conversation harder for banks. When a young investor sees a low-cost, broad market ETF, they may ask a fair question: why am I paying more for something complicated if a simple product can do the job? This does not mean all advisors are useless. Good advice has value. But expensive products with unclear benefits are harder to sell in a world where people can compare costs instantly. The third reason is trust. Young investors are not only looking for returns, they are looking for transparency. They want to know what they own, what it costs, and how it fits into their future. A simple ETF portfolio can feel more understandable than a bank product explained with complicated language. And when people understand something, they are more likely to stick with it. The fourth reason is culture. Finance used to be private. People did not talk openly about portfolios, salaries, budgeting, or investing mistakes. Now money content is everywhere. YouTube, TikTok, Reddit, newsletters, podcasts, and finance creators have made investing part of everyday conversation. Some of that content is dangerous, some is shallow, some is hype, but some of it also taught young people basic truths that earlier generations were never taught clearly. Start early, diversify, keep fees low, do not try to time the market, invest consistently, understand compound growth. Those ideas helped push ETFs into mainstream culture. The fifth reason is frustration with banks. Many young people use banks, but they do not feel emotionally loyal to them. If a bank offers low savings rates, confusing fees, and outdated service, while an app offers simple investing, cash features, and a clean interface, the relationship shifts. The bank becomes a utility. The app becomes the financial home. That is a big change. Banks used to control the customer relationship. Now apps are fighting for it. But the ETF boom also has risks. Easy access can create overconfidence. A simple app can make investing feel like a game. Bright charts, instant trades, and social media hype can push people into risky behavior. An ETF can be diversified, but not every ETF is safe. Some are concentrated in one sector. Some use leverage. Some follow trends. Some sound smarter than they are. The word ETF does not automatically mean responsible. That is important. A broad index ETF can be a long-term wealth tool. A hype ETF can become a speculative bet with a nicer label. The second risk is panic. Young investors who started during rising markets may not know how they will feel during a serious crash. It is easy to say, "I am long-term," when the screen is green. It is harder when the portfolio is down 30% and every headline says worse is coming. The third risk is fake simplicity. Apps make investing easy, but building wealth is still slow. A low-cost ETF is not a lottery ticket. It is a tool for long-term discipline. If people expect fast riches, they may jump from strategy to strategy and destroy the very advantage ETFs give them. So what is the real story? The ETF boom is not just about a financial product. It is about power moving from institutions to individuals. Young investors do not want to wait for permission. They do not want to be sold products they do not understand. They want a system that feels clear, cheap, mobile, and under their control. That is why banks should be paying attention. The next generation may still need banking services, mortgages, advice, and retirement tools. But loyalty will not be automatic. It must be earned. The climax is this: ETFs did not make young people rich overnight, but they gave millions of people a simple doorway into ownership. And in a world where wages feel uncertain, housing feels expensive, and retirement feels far away, ownership matters. The app is not the revolution. The habit is. Small amounts, automated, invested consistently over long periods. That is not flashy, but it is powerful. The ETF boom is really a story about a generation trying to build a future without waiting for traditional banks to guide them there. But there is a hidden risk inside this new freedom. When investing becomes easy, it can also start to feel like a game. An app can make long-term investing look as simple as scrolling social media. Prices move, buttons flash, charts update, and the line between patient investing and emotional trading can become blurry. That is important because ETFs are powerful tools, but they are not magic. A broad, low-cost ETF held for years can be very different from jumping between trendy funds every week. One approach builds discipline. If an app makes investing simple but does not teach risk, it may create confidence without understanding. And confidence without understanding can be expensive. The best version of the ETF boom is not young people chasing every hot theme. It is young people learning ownership, diversification, patience, and fees. It is someone realizing that building wealth does not always require picking the next winning stock. Sometimes it requires doing the boring thing consistently for a long time. That is why this trend matters. It is not just about apps replacing banks. It is about whether the next generation uses technology to build wealth, or whether technology simply makes it easier to make faster mistakes. And in the end, finance is not just about numbers on a screen. It is about the choices we make, the systems we live in, and the future we are trying to protect. If this video helped you see money a little differently, subscribe to the channel for more clear and honest finance breakdowns. Thanks for watching.